My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to America. Other people want to make friends. I'm just trying to make you a little money. My job, not just to entertain, but to teach, educate. Call me, 1-800-743-CNBC, or tweet me at Jim Cramer. We've got a grand confluence going today, a sudden confusing lurch out of the banks and the industrials and into the techs and some retail. This is a move that seems to make no sense to most investors, but you've come to the right place because it's my job on this show to bust authentic Wall Street gibberish and explain the action in plain English. So pull up a chair and let me tell you what's driving these insane, some would say inane, moves, with the Dow losing 210 points today, the S&P dipping 0.04%, and the Nasdaq jumping 0.87%. Crazy, huh? First, we got to cut through the nonsense that you hear constantly from the hard money ideologues who try to pretend not to be that, and their oligarch buddies who try to pretend they're trying to help the poor, who want higher interest rates because they're worried that long-term inflation will actually erode the value of their billions. These are the people who think our valiant Fed Chief Jay Powell is nothing more than a patsy. They want the Fed to stop helping regular people find jobs by keeping rates low. And they have the gall to argue that inflation actually hurts people who work for a living more than anyone else. You know that's false because what these kleptocrats fear more than anything is wage inflation. They don't want to have to spend more money on payroll. Every time we get a strong labor market, they want the Fed to step in and crush the economy so they'll have more bargaining power. And believe me, they somehow think that it's more important that people don't have jobs or make a little bit of money than they do getting jobs and having some money. Don't get me wrong. I lived through the 70s. I was very big in the unions, worked hard, shop steward. I don't want to go back to a world with double-digit inflation. But we don't need to be so ruthless about stamping out even mild inflation. It's just not worth the trade-off. And that's what's so great about this Fed chief. He's figured this out. He knows that businesses, particularly black and Hispanic-owned businesses, are far more likely to get started before a new rate hike cycle begins than after, and he wants to help them. But for all their hand-wringing that Powell didn't do enough yesterday, the fact that he pulled forward the approximate start of the rate hikes, he's now saying late 2023 instead of 2024, has been interpreted by some big money managers as a clarion call that the Fed's finally getting tough on inflation. Now, I think that's totally ridiculous, okay? But the bond market disagreed with me. Stunning session. Bond prices went flying. Bond yields plummeted. The bond bullies have collectively decided that Powell finally means business. So they're buying it hand over fist. Man, they're deluding themselves. It's not that he doesn't mean business. He's just meaning business in a different way. Remember, the bond market is much bigger than the stock market. So when investors see bond yields falling, they think, uh-oh, the big turn in the economy that we thought could continue because Powell's so easy and won't even acknowledge inflation, that's over. And that's how you get a stock like Caterpillar, a good company, tumbling nearly $8, down almost 40 points from its high. 40 points. That's how Freeport McMoran, the copper company, could sink more than $10 in a month's time. It's why anything connected to commodities is plummeting. Now, to everyone who's worried about commodity prices, I got good news for you. The stock market, which is pretty correct on these kinds of matters, is saying that commodity inflation has already peaked. What the kleptocrats think is such a worry, it's not. Forget transitory. The market's saying it's pretty much over. Sure, the market could be wrong. But if you were worried about totally out of control inflation, that possibility has been taken off the table. Just take it off. You're looking at a sudden collapse in every stock related to commodities at the same time that long-term interest rates are crashing. That wouldn't happen in a world with wild and crazy inflation, like so many of the ideologues tell us is happening. Turns out Powell was right. Turns out it really was transitory. Powell didn't need to raise interest rates or taper his bond buying. He just had to float the possibility of maybe tightening a couple of times in 2023, and the problem took care of itself. Now, there are a few shortages that are more intractable, but I've got solutions even for them later in the show. Earlier this week, I told you this market would be unable to mount a traditional rally until oil starts going lower. Well, guess what? Now oil's even reversed, and reversed hard, because we're hearing that the Saudis are ready to start boosting production. This level has been terrific for them, but if they let the price of crude go any higher, then the shale producers in our country will start drilling again. Remember, they're down 1.9 million a day from what they were doing, and that's the last thing the Saudi Arabians want to see. They want to keep oil high enough to make a ton of money, but still low enough to keep their undisciplined American compadres on the sidelines. Tomorrow we get the Baker Hughes rig count number, and I bet it's going to show an uptick in drilling, making the Saudis even more eager to put a lid on petroleum. Yeah, transitory. So what about this insane rotation into tech and fintech? That's easy as pie, with an E. Money managers are selling the industrials because they're convinced that Powell's about to get tough. It's like they don't listen to a word this guy says, not a single word. When you think the Fed's getting ready to tighten, the hedge fund playbook says you need to buy traditional senior growth stocks like FAANG or Microsoft, or the semiconductor companies like AMD and NVIDIA. All of them will outshine the smokestack stocks in the slowing economy. Facebook has triumphed over its critics and remains a great bargain for advertisers. Amazon's about to have a super prime day. Apple's working the kinks out of healthcare, despite what the newspapers say. Netflix has a better slate of programming now that COVID's coming down. Google's got strong businesses everywhere and a new sense of discipline when it's coming to spending. I know there's no M in FANG, but I think Microsoft deserves to be an honorary member because it's in such good shape. How about the chip makers? At first, I thought NVIDIA soared nearly 5% today because my wife, Lisa, is getting a new rescue dog, and she agreed that I can call this one NVIDIA 2, just like its predecessor. No, that wasn't it. It's just that the company caught a recommendation today saying that the growth is accelerating, which it is. Plus, people are coming around to believing that NVIDIA will be able to acquire ARM Holdings, just like Jensen Huang told us. Same story with AMD and its acquisition of Xilinx. It will no longer be pigeonholed as the knockoff version of Intel, when actually Intel is now the knockoff version of AMD. Meanwhile, all the fellow traveler cloud kings and cybersecurity stocks held hands and rallied, too. We just had Twilio on the show. Great story. Natural flyer, a few today. And then after the close, as we predicted, Adobe shot the lights out with an amazing quarter that is certain to have a ton of pin action tomorrow. Now, I know there are people who argue that home builders will be squeezed by inflation, but that's a tough road to hoe when you have one of the biggest ones, Lennar, reporting that it had great sales and terrific margins. Terrific margins. Remember, everybody was saying the margins are being crushed? Will they please do some homework? I didn't get up at 3 a.m. to just kind of like listen to the birds. They get up at around 4 anyway. I know mortgage rates have had a little spike, but with bond yields coming down, that's over. Let's see the home builders can weather inflation. I think they are. Rates are down, so affordability is up. That means you should buy. I just got another mortgage today. I locked it in. What the heck? Why not? They're giving them. I'm taking them. Of course, the market's stubborn. Actually, that was for the rest of the farm that I bought with that Ethereum and that other thing, that Bitcoin. Anyway, these buyers think the economy's slowing, which means there will be no near-term rate hike, something the banks need if they're going to save their quarters. So be careful of all but a handful of the traditional financials and go buy the fintechs while they're still down. Square and PayPal are going crazy. There are fintechtuals. Now, does any of this make sense? Sure for today. I mean, I say for today, because some of this buying is big, bad event buying, meaning the bulls were waiting to see what the Fed did before they swarmed in. And we know we're in a seasonally weak time, so I suspect that some of these tech stocks will give up their gains. But the bottom line, the buyers and sellers have spoken. They think J-Powell means business, but not anytime soon. And the hyperinflation theme, well, that's now off the table, where it should have been all along.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.